it's always the same tools that I'm looking at, regardless of market, regardless of asset class. However, some markets I focus more on one tool, and other markets I focus more on another tool. Like for instance, when we compare, and that's a good example, I think, equity indices versus gold or versus euro dollar. So when we look at equity indices, my focus is heavily on seasonality and market cycles, like election cycle right now. We are right now in the market is moving based on election cycles. So that elections in the election cycle, it's a 4-year period, right? So there's pre-election, election year, post-election, and midterm election. So right now we're in the election year, US election cycle, right? So based on and then I'm looking at election cycle seasonality basically. Plus I'm looking at valuation versus the interest rates. Plus, on top, I'm looking at COT data, some derived COT data, how the retailers, and which would we consider the dumb money in the market, because if we look at our tools, we can always tell the retailers are always wrong. So that's so the biggest learning is that if you look at these tools, if you see the retailers on one side, don't trade with them. Always trade against the retailers. They are 90% of the time wrong, regardless of market, right? And then we're looking at smart money, which are we call, based on the COT, are the producers, all right? So now and when we look at, as I said, equity indices, my primary focus is on cycle seasonality and valuation versus the interest rates. If I'm undervalued or overvalued versus the interest rates. But if I look at gold or euro dollar, I would focus on the COT index first, right? At the retail behavior. And by the way, this is not sentiment. It's they're literally positioning in the market, right? Positions in the market. Smart money, the commercials and the producers versus the retail behavior. And then I would go to valuation. And for instance, if I look at the euro dollar, I would look at the valuation versus the dollar or versus gold, right? And see if we're undervalued versus gold and versus the dollar, or overvalued. And then only then I would look at market size cycles, at seasonality, for instance. So how I look at things differs depending on market, if this makes sense.
Okay, so let's say we've come into your tool and it's taking all of this information to derive your graphic representation, and it's just happening to say euro dollar is going to be extremely bullish. It's the best opportunity for this week out of all of the reports you have. Now we decide this week we should be coming to euro dollar because my tool, based on economic data, has told me this is the best opportunity. What would that data look like before we decide how to technically enter? What would that data look like for euro dollar to be bullish? How would that present in your reports?
Actually,
just so people that don't have a tool, they can start to see, okay, I need to look for, in the COT, I need to look for this.
Yeah, that's very interesting, because I could make even a live call, trade idea live call, not a real trade idea, but I can tell that this year the dollar is going to be extremely bullish. So because the dollar is just an index, and the biggest market in that index is the euro dollar. So obviously the euro dollar is going to be bearish, right? So, but the dollar is going to be very bullish this year. How can I tell? Because the retail positions are almost at all-time short. So the retailer are positioned almost all-time short on the dollar index. What does it tell me? Retailers are always wrong. If they are not only a little bit short, and not only if they are all time basically short, it's the best indicator to know that dollar gonna rally like crazy this year. Whenever this is gonna happen, I cannot tell yet. Okay. But what I'm going to do then is basically, okay, I'm looking at valuation versus dollar versus gold and dollar versus the euro, for instance. And look, once we are undervalued, plus at the seasonality of the dollar, if then all stars are aligned, then I'm like, perfect, right? So I see already the retailers are super bullish, bearish, all-time low bearish. Then I'm looking at valuation, I'm waiting for the dollar undervalued versus the euro and versus gold, ideally, maybe even versus interest rates, versus all the three markets. And then I'm looking at seasonality, where I can literally time, okay, that's from a seasonal perspective, the low is next week. and then I know all my stars are aligned, so all rules are met, and then I go to step 2 where I time the market, and that's how I can make these bold predictions to say this is going to happen, and
which you have done,
which I've done before.
So the I like your term all stars aligned. The way I kind of say is A+ setup.
Yeah, it's the same
your
thing.
All stars aligned on a currency pair is going to be your positions in the retail perspective. It's going to be your seasonality and valuation.
Exactly, perfect.
Once you've got the best all stars aligned for that, then as you said, I know it's going to be bullish this year. I just don't know when. You need to come into a technical base to decide when is right to enter. So let's say your leading indicator on Sunday has told you this all stars have aligned. Now you come into the market. What is your process now from Monday until you actually take an entry because then it will all be technicals.
Yes, and it's all be technicals. Then I would look at supply and demand. I would start with the weekly time frame. Look where so let's assume now I'm bullish on the dollar, right? So I'm looking where do I find close by weekly demand, right? So this is I call it big brother, small brother principle. So the small brother has to be covered by the big brother. So the weekly is the big brother because the big brother is kind of helping for the price to move, right? But I'm not timing the big brother because the weekly zone is not giving me the risk to reward proposition that I want to have, right? But I want the smaller time frame, the lower time frame, so the weekly is the higher time frame, the lower time frame, which is then the daily, so I move from weekly to daily, which is then my execution time frame. So, but the daily
on the daily.
Yes.
Not 4 hour, 1 hour or anything.
Nah.
Wow, okay.
Nah, daily. Also, yes, because of the risk profile that I have now, right?
So your average stop is a daily demand or daily supply.
Demand zone, yes.
That can be on, let's say, euro dollar, like 30, 40 pips.
I have no idea because I never look at the pips or the points. I just look at the zone, right? I know I look at the demand zone. I know, okay, this is where I want price to, where I want place my entry, and this is where I want to place my stop loss. And that's it. And then the area, right? The gap, right, from entry to stop loss, that's my risk profile. In that case, if we talk about a $1 million account, the $10,000, regardless of pips. If it's like 50 pips, 60 pips, 100 pips, I don't care.
Put a position size accordingly. And when it comes to your profit taking or position, because you mentioned that it's going to be bullish. So just as much as you don't know when it's ready to enter, maybe it's hard to tell when it's time to exit. So do you exit based upon a fixed R profile, or is it based on a technical structural high, or is it just you hold it into your fundamentals
shift? Yeah.
Interesting. Until so your trade longevity or trade duration, let's say, is unconfirmed when you enter. It just depends on how it goes.
So for beginners, I would always use technicals to place the target as well. For instance, if you enter in weekly or daily demand, you would exit or put your target at the opposing supply zone, right? The next daily or weekly supply zone, because this is where you would expect your price to go move from one area to another area.
Just to clarify that, let's say you're just having basic market structure bullish, you've entered on a demand. So then you would hold that to go to the last higher high, or keep going to then a higher time frame supply.
Exactly, to a higher time frame supply.
Okay, so you'd have a higher high for sure on a
that's
bullish,
what I would expect. Yeah,
structure.
if there's no always the next, basically always the opposing zone would be like where I would technically expect price to go.
Now, what are you doing on your personal? Are you doing the technical, or are you just waiting for your fundamental
That's
drivers?
why I say, like, for a beginner, I would use technicals because it's more objective. It's easier to do. But for me, more experience, I check the fundamentals and wait for them to shift, and then I can also get out. Right?
Okay, and when you're doing that, because then for me, like, little alarm bells can go off. For example, first of all, your psychology of if you're holding a trade and you don't know how long, you're just waiting for things to shift, but then it's made the new high. You're now, you're significantly in profit. You've had a strong move.
Yeah.
How do you manage the emotions knowing that I'm not targeting the supply zone? I'm just going to hold and hold and hold until the market fundamentally tells me it's going to change. Does that affect your mind, or you just
Well, I had to learn this.
Okay.
I had to learn this and to digest these swings from a P&L perspective. So how I learned this and what rules I put in place is I'm not looking at my MT5 anymore. Well, the only thing that I do is literally I place the trade. Once I get triggered, I just look that I literally got triggered. Everything is fine. My stop loss is in place. And then I switch off, right? Okay. So even my MT5 app on my mobile, I've hidden somewhere very, very deep in a folder structure that I not just randomly click on it. Throughout the week, I'm not clicking on it because it's really different. And I have to admit, it's really for me as well, because I constantly try to scale my funds now, right? So now I'm trading 4 million in prop firm capital, which is like, if I take 1% of risk, is $40,000 risk per trade. If I can trade that market on all prop firms, basically, but it's $40,000 risk per trade. So of course, if it goes up like a 1 to 2 and you're in profit $80,000, and then it gets another retracement back down, and all of a sudden it like cuts in half, and you would look at that P&L constantly, it would like, it drives you, that roller coaster, it's not healthy, you know, that roller coaster lifestyle, looking at your P&L going up and down, for nobody in the world it's healthy. And this is where when you start acting emotionally in the market, and you then prematurely close your position, move your stop loss, do this and that. It's not analytical mindset anymore, it's the emotional mindset that acts.
So when, let's say, just to run a hypothetical, let's say you entered and your fundamental bias was correct, your technical entry was great, you're in profit now, and you've passed a swing higher high. So you're now greatly in profit, you're just targeting a supply. Now price is entering towards that supply, but your fundamental indicator or driving tool has told you don't exit yet. Are you going to take money off the table, or do you take partials along the way, or do you just hold until the fundamentals tell you?
I've also seen that you take partials, right? You have multiple targets, I think.
I have fixed partials, two zones, simply because, and I can explain briefly.
Please.
I didn't want to have this emotionality. So I used to be quite a swing trader, and I just had these things of like, I would be greatly in profit, and then a healthy retracement of 50%, you'd feel it.
You feel it, yes.
And when you're doing decent risk reward, it's just hard to stomach. And what I also realized is there's opportunities to re-enter. So I completely optimized my system for just session volatility. If I can just know where the session is going to go, not the rest of the day, week or month, just the session on GU, which is about 30, 40 pips a London session or London Open. If I can just get an entry with, it's going to sound foreign to you, with a 3 to 7 pip point stop loss, and I know London session is going to be 30 pips on average. If I can just optimize for that, I can kind of be in and out in the session. And then I kind of optimize my profit taking, not subjectively based on structural lows or anything. It was just 1 to 3 and 1 to 10, and I cut it. And that was based on my data. When I took a sample size of 1,000 trades, it just told me the optimal place to take my partials based on my strategy and edge was these 2 points. So you're now doing like a subjective approach based on what your indicator is telling you.
Actually, it's still objective, I would say, because the
tool tells you.
Yeah, the tool is really objective. It's not like me eyeballing.
True.
I think it's really objective. Like I see when it, like from, again, it looks like for instance valuation, right? It looks literally like an RSI overvalued. It's like how do you call it on an RSI? Overbought,
Oversold.
Oversold. I don't even know, right? Overbought, undersold. So it looks literally like, so if for instance, if I trade CFD stocks, if I enter the market and if I'm undervalued, I would get out if I'm overvalued, because this is when I would expect price to drop.
And how often is that indicator updating, or like new information comes in and moves? As a
It's
daily report?
daily. It's daily. So 2 of these tools are daily, and our smart money index, which is derived from the CUT index, basically, is weekly.
So did you intentionally transition, and probably because it was more profitable for you, transition away from taking profits based on technicals to now taking profit based on fundamentals?
Yes.
Did that improve your profitability? Or was there another reason of
big
psychology?
Big time.
Oh, yeah.
Because as I said, fundamentals drive price, and you can really catch the market turns. The fundamental market terms, the big market turns, the weekly market turns. If you catch these market terms, price can go almost forever because you catch the new trend at the bottom or at the top, basically. And then if I got out on these trades on the next opposing zone, I would miss out on a lot of profit potential.
And when it comes to your position size, let's say you've risked $10,000 on a trade, and is there any way you're going to take, let's say, $5,000 of risk off?
No, it's always all or nothing.
Oh, wow.
That's how I learned.
Why?
I learned
well, because of I used to do something similar, and I realized that if it doesn't reach my final target, but I was up a decent amount and it came back to break even, it's all or nothing, yes. So I didn't lose anything, but I kind of valued the opportunity cost of I was up 15,000 and that 15,000 came back to break even. That was kind of money lost as I viewed it.
I fully understand you, and I fully get you. But based on because in the very beginning, I was also, I was journaling and logging all the trades. And I always had, for me, what is really important when it comes to logging, I always had a imaginary target where I was like, I take a conservative target, but also a target where I just put a line in, and I said, okay, this is where I think price could go based on my tools.
Okay.
And based on my sample size, most of the times, literally most of the times, price went to my, I think price will go there target, right? So because then I saw, okay, I can trust that system, so I'll change my approach from conservative target to that's where I think price can go, think, quote unquote, think, right?
Just for a bit of clarity on my end, let's say your final destination or your average winning trade, which goes to your preferred zone, how many R is that based on your risk?
Well, it can be between 1 to 1 and 1 to 4. But imagine there's a daily zone, sometimes even a weekly zone. If I cannot refine it, if it's hard to, if I, for instance, what I would consider daily level on top of level, if you have very like
alignments,
two daily demand zones that are close by, like one below, and you basically don't know where price is going to stop or turn. Is it the first level or is it the level below? And then I say, I just don't know, right? I would just combine both levels. So basically, I would sacrifice. I would basically then, sacrifice on risk to reward, but increase the probability of getting filled and being in that trade, and also increase the probability of not getting stopped out.
Yes, yes. You give yourself a healthy buffer.
Exactly.
Okay. So on that one, let's say your preferred zone is the 1 to 4. It's one of your better scenarios, and price goes to 1 to 3.
Yes.
So your 3 are up, and then it goes back to your break even.
This doesn't happen. No. Then I would Then I would know. I mean,
you would see it in your indicator.
Then I would at least, I trail along the way. Like I would not.
Are you trying to stop? Okay,
I would not. Well, I mean, it could happen obviously that I'm up then 30,000, and then I'm going, price goes back, and I'm only taking 15K, right, or half of it. But this happens. Obviously, this happens. But yes, but I would trade. I would never let. And this would be bad. This would be bad money management, right? Because I would be a bad risk manager if I'm $30,000 in profit and then I let it go back to break even, or even some traders would let it go back in because they don't want to be wrong and they think I'm now right. This is like the mental trap. They would even lose then. No, this is not happening. Then I would be a bad risk manager.
Yeah, right? The reason I ask is because my biggest growth in my 7 years of trading is the last 2 or 3, and the last 2 or 3 I didn't have to modify too much my strategy. I just